Hello everyone and welcome to Fun with Fitzy. This is Chapter 2, Video 1. We are going to be focusing on the recording process. Okay, before we do that, just a reminder of what an account is. An account is found in a ledger, and it is an individual accounting record of increases and decreases in a specific asset, liability, or owner's equity item. Debit and credit mean left and right. That's it, nothing else. Debit means left, credit means right. The act of entering an amount on the left side of an account is called debiting the account, and making an entry on the right side of the account is crediting it. When the debit amount exceeds the credits, an account has a debit balance. And the reverse is true. If the credits exceed the debits, then it has a credit balance. Okay, in its simplest form, an account consists of a title. Remember our T account? A left or a debit side and a right side, and we call this a T account. And this is what it looks like. So here's our title down here. Here's the left or debit side, right or credit side, and if the account's debits are greater than the credits, it has a debit balance, and if the credits are bigger than the debits, it will have a credit balance. Here is just an example of if you kept track of increases and decreases in your account without using a T account. You would have an increase of 15, a decrease of 7, and so on, and you'd get a balance in the account of 8,050. However, when you use debit and credits, increases to accounts like this, which is an asset, go on the debit side, and decreases go on the credit side. So it's much like subtracting it, and then you end up getting a balance. In this case, a debit balance because the debits are bigger than the credits. So let's do an example of debiting an account. Here's a transaction. The owner makes an initial investment of $15,000 to start the business. Therefore, cash is debited and capital is credited. Remember, assets are on the left-hand side of the balance sheet, therefore have a normal balance on the left and increase on the left. Owner's equity accounts are on the right-hand side. Same with liabilities, actually, and they therefore have a normal credit balance and increase on the credit side. Okay, now we're going to credit it. In this previous transaction, we just showed the one account, but remember, every transaction your debits must equal your credits. Okay, let's credit the account now. Rent of $7,000 is paid. Cash is therefore credited. And in this case, rent expense is debited. In every transaction, your debits must equal your credits. So here we have just a little quick demonstration of how we debited it for 15 and credited it for 7. That means it increased by 15, then decreased by 7, and therefore we have an $8,000 balance, which is a debit balance. Something to remind you of, double entry accounting. We talked about this in grade 11. It means debits always equal credits for each transaction, or every single transaction must affect 2 or more accounts. Okay? The accounting equation will always stay in balance. Remember our accounting equation? Assets equals liabilities plus owner's equity, or assets minus liabilities equals owner's equity. Okay, I already talked about normal balance, but just to remind you, every account classification. So when I say classification, I mean assets or liabilities. And they all have normal balances. Either it's a debit or a credit, which means in this case, the account has a normal balance on the left side, or in this case, a balance on the right side. So assets normal balance goes on the debit side, and I always remember because assets are on the left side of the balance sheet. They also increase on the left side. Liabilities have a normal balance on the credit side because they're on the right side of the balance sheet, so they should have a normal balance on the right side, and therefore they also increase on that side. Owner's equity has a normal credit balance. Like liabilities, it's on the right-hand side, and therefore it also increases on the right side. It gets a little tricky when we add revenue, expense, and drawings here. Drawings is when the owner takes money out for his or her personal use. And when this happens, it decreases owner's equity. So when owner's equity goes down, it goes down on the debit side. However, when the owner takes money out, we say we debit it because owner's equity is going down, so we want to debit it because owner's equity is going down. But we say drawings is going up because as he continues to take money out, we're accumulating that balance. Revenues increase capital. That's when you earn money for performing a service or sell something. Revenue increase owner's equity, and when owner's equity is increased, you credit the account. Therefore, it has a normal credit balance. Expenses decrease owner's equity, and therefore we're going to debit it, just like in drawings. Okay, so here's the expanded equation. Assets equals liabilities plus owner's equity. Assets have a normal debit balance, an increase on the debit side, and everything here, liabilities, capital, and revenues have a credit balance, and they increase on the credit side. However, drawings and expenses have a normal balance on the debit side. So by now, you should be able to understand what debits and credits are, what an account is and a ledger, what for each account classification, what the normal balances are. Thanks for watching. Hope this helps, and we'll talk to you soon.